Good morning. Welcome back to another CPI inflation report. This is Meet Kevin report number 104, live every single morning. The market is open, usually around 4:20. A little bit later this morning because I figured, you know what? Why are we going to be early so morning? Would be so early on a CPI morning if the data might be just about to change in about 24 minutes? And in about 24 minutes from now, we are going to be getting exactly that new CPI data, which we'll cover in just a moment. But we have a big rent topic to talk about between now and then. Quickly want to remind you that we have another price increase for those programs I'm building your wealth linked down below, coming at 11:59 p.m. on this Friday the 16th. We do increase the price over time as we add more value, and since we continue to add more value, the price tends to go up over time. And so we also have a price match guarantee, so that way, in the event that for whatever reason you were concerned that the price might be lower in the future, we'll guarantee it. If you ever have an issue, just email us at staff@meetkevin.com. Also, keep in mind that you get lifetime access to the programs and the live streams, the custom fundamental analysis live streams. When you join, we do a lot of fundamental analysis. A lot of our fundamental analysis was leading us to chip stocks in November, which was a great time to get in, as well as Tesla was looking obviously good. Now we're doing new fundamental analysis on new companies and looking to add exposure to those. So we'd love to have you in the course members group. Anyway, for now, let's talk about this update regarding rents. Stand by 1 second. There we go. Okay, I think I fixed that. And there we go. Adjust that camera a little bit and we're looking good. Okay, so let's get into this rent update. This was pretty remarkable. So, great piece by the Wall Street Journal just out. It talks about renters about to get the upper hand. First thing I saw this morning, Wall Street Journal, renters about to get the upper hand. And I have to say, one of the things that makes me so interested in this title is when I was exploring real estate almost every single day in January, February, March, in preparation of where was our real estate startup going to be hunting to likely buy. What we found was it was very difficult to do research on rental comps because this is very important. You can't just look at sales comps and sales prices, but if you're going to rent out properties, you have to look at rental comps. And one of the issues we were having with rental comps, and this will relate to CPI as well, which is quite interesting, but one of the interesting things about rental comps was there were so many rentals available. There were so many, they were everywhere. And that actually made it very difficult for us to purchase or think about buying because we were not able to evaluate a stable rent at the time. We thought there was a very high likelihood that rents would come down very quickly given the availability of rentals. And that made evaluating property values difficult because your competition might look at, well, rents today are $2,200, and they're like, well, I'll overpay for the property. And we're like, rents might fall to $1,900. So anyway, now we've got a piece. So that's obviously a big concern for us as a buyer. And remember, our goal is to try to find fixer-uppers and to turn them into properties that actually enter the rental market. So now you're taking properties not in the rental market and adding them to the rental market. So we're potentially also adding that supply pressure, which is good for renters, right? Because the renters get better deals. But anyway, apartment rent growth is declining fast, shifting the rental market to the tenants' favor, says the Wall Street Journal. The average of 6 national price rent measures from rental listings and property data companies. Think about that. The average of 6 of them together. The average of 6 of these rental listing measures together rose just an average of just under 2% in the last 12 months over May. And that's it. That's basically nothing. And honestly, it's probably about to go negative. That's also down from the double-digit increases that we saw a year ago. And this is also the largest deceleration of year-over-year numbers ever in rents. The annual decline would offer relief for millions of renters who've had to contend with rents going up over 25% nationally in less than 2 years. And I think it's worth mentioning sort of some clear empathy here because it's totally valid. But there are obviously a lot of people who are suffering from substantially higher rents now than we had before COVID. I just want to remind you, it is not the Federal Reserve's job to reduce prices. I tweeted yesterday, which I actually think, I'll just pull it up. I tweeted something yesterday, and it's just remarkable to me that even despite this tweet, I think I have to be even more clear. there is a massive misunderstanding of what the Federal Reserve's actual job is. I think people think the Federal Reserve somehow has a mandate to get prices back down to where they were, before COVID, and this could not be further from the truth. I mean, it's the opposite of the truth, and it's sad because I don't want to see people so terribly misled. But anyway, oops, almost spilled my coffee. Anyway, this is what I tweeted yesterday. If comments like these represent bears or retail on the sideline, I'm happy to be bullish. Hint, their comment fundamentally misrepresents what the Fed is trying to accomplish. Very common comment, sadly. This was the comment. And I'll tell you, I see stuff like this all of the time, and I've mentioned sort of some frustration around why do I keep seeing this kind of crap over and over again? But I do, and so I thought, okay, all right, well maybe what we'll do is we'll at least tweet it and talk about it. So anyway, I did, and the following is what I said. The following is the comment rather. The comment is, everyone keeps saying inflation is going down. I would sure like to see that. Prices for everything I buy sure as heck are not going down. Yeah, it's very unfortunate because this is again exactly the opposite of what reality is. The Federal Reserve is not trying to get prices down. In fact, the Federal Reserve is blatantly trying to, dare I say this, increase prices on you. So think about that. If you're somebody who actually thinks the Federal Reserve wants to lower prices right now, you're probably just never going to invest in the market because you'll just wait for prices to come back down to pre-COVID levels and think that, oh yeah, okay, now things are normal. But the reality is you'd be completely missing out because the Federal Reserve is blatantly telling you they want prices to go up by 2% per year. Falling, the inflation rate falling is highly different. The inflation rate falling is the level of those price increases either stabilizing or normalizing. That's the goal. But this nonsense, it's just one day maybe it'll stop. But that's my goal. Is maybe we can continue to add some education. But anyway, let's keep going with these rents because it really is, at least seemingly quite remarkable. And again, hopefully, this ends up being true. We want this to be true, but we want rents to come down because it is also another indicator that the Federal Reserve is looking to evaluate whether or not inflation is actually becoming unsticky. Remember, there are three categories of inflation. We've got goods inflation, which is almost in deflation. Then you've got housing, and then you've got everything but housing. So that's important because if we now think that, okay, well, rents are actually going to start falling, that'll be a nice disinflationary pressure, especially since housing represents somewhere around 34% of CPI, which is actually revised from last year, and also kind of remarkable that all of a sudden housing represents more of the consumer basket, according to the Bureau of Labor Statistics, who puts all this good stuff together, or rigged stuff, depending on what side you're on, I suppose. But anyway, continuing with this Wall Street Journal piece here, a year-long drop in rent would be a potential problem for many investors who took out large loans to buy buildings where they thought they would be able to keep raising rents. This is one of the things I teach about. I teach in my Zero to Millionaire real estate investing course. One of the biggest things I argue is that you're better off renting the property for slightly below market value because then you can attract a higher quality tenant. And not only can you attract a higher quality tenant, but you're going to be in a position of power where you're able to actually raise rent in the event that you need to. In the meantime, your tenant benefits with slightly lower rent, but everybody benefits. You benefit, they benefit, right? And so this makes for a very good win-win relationship with tenants. In my opinion, knock on wood, this is why I've never had an eviction. Why Lauren and I, we've never had an eviction. We hope to never have an eviction. Of course, with House Hack, we'll have a whole lot more properties, but again, we think we'll bring the same principles over. And you can't bet that prices will only go straight up. If rents go down, you have to be willing to offer tenants essentially a rental reduction. And unfortunately, there are a lot of people, especially syndicators, who started taking out real estate loans that suggested, we'll get real estate loans that are interest only that adjust every single month. Imagine how stupid that is in a rising interest rate environment. But it actually happened. Now, it's one thing if you have an interest rate like a lot of people took out ARMs before interest rates started rising, adjustable rate mortgages. And they did that because they thought, okay, well, if a 30-year fixed is 3%, I can get an ARM at 2.6. Hey, I win. And usually with a homeowner conventional style loan, that interest rate can only adjust up 1% a year or with some kind of cap. Well, with a lot of these commercial or multifamily style loans, these interest rates are actually adjusting every single month. So all of a sudden, when rates go up 6%, you get this massive adjustment every single month. It's insane. It's just literally insane. Okay, maybe they didn't go up full 6%, but even 5%. Anyway, so now that leads to a softer real estate market, falling property values, and ultimately, those lower rents are great for tenants, but it's not so great for multifamily investors. Now, what I think is potential, because obviously real estate dipped from last May. It dipped down from last May to about December. Real estate prices came down nationwide. They came down about 10%. Some areas, Austin, Idaho, they came down about 20%. Some parts like Florida, they really didn't come down much at all. A lot of this still has to do with migration trends. Now, what's remarkable though is if commercial real estate softens the way it has been, and multifamily softens the way it has been, then what eventually ends up happening is you get a lack of investor capital that goes into single family because there are deals to be had in commercial and multifamily. And that lack of buying pressure potentially leads to a reduction in single family prices as well, but only to the extent there's actually enough inventory, which there's not right now. So you've got a really interesting real estate setup. The good news, though, is from an inflation point of view, the decline in real estate should be very palpable today when the inflation report comes out. I mean, consider this. Although, do keep in mind that the CPI report is really only expected to have seen rents peak last month, and it's a very lagging indicator of what rents are actually doing. Consider this. Redfin's rent asking data shows a decline of year-over-year rents of 0.6% in May compared to last May, and that includes both apartments and single families. A decline in asking rent over a 12-month period has only happened one other time, and it was the 2008 financial crisis. And then, of course, I mean, you could look at COVID, but that was rare. There was a brief rental dip during 2020, but beyond that, 2008 was the last time we had an actual negative year-over-year rental dip. U.S. rental market is slowing down after such an unprecedented run, and they give some examples here. Historic new number of apartments under construction. You also, by the way, have a historic number of single families under construction. The pipeline of homes under construction is somewhere around 740,000 homes still to be built that are under construction. A lot of these still selling on properties that were acquired by these home builders in 2020, 2021, where home prices were actually lower. They were actually able to get better deals on lots back then, and they're just now selling those. Fallen rents would follow a recent price decline in the housing market, max price decline of about 1.7% from a year earlier, which is actually relatively nominal, but that's because we've had gains again since January through to now. But new leases, which measure the change in prices for apartments available to be leased to new tenants, are considered more of a leading indicator. As new lease rent prices cool, landlords are also expected to keep dropping how much they're asking tenants to pay. Property owners who don't lower rents are likely to see their tenants move out, driving up vacancies and eventually driving up sales. The dynamic is starting to shift, specifically in markets they suggest here, like Jersey, looks like Vegas as well. And I mean, you can kind of look at each individual market as well. But anyway, overall, 48 of the largest 100 US cities are posting negative rent growth for new leases as measured by Apartment List. Now, this is fascinating to me because it comes at the same time as you have this massive uncertainty in commercial real estate. I mean, there was just another piece in the Wall Street Journal about hoteliers walking away from hotels in San Francisco. And I mean, San Francisco might be an anomaly because it's totally an SH9T show. Like San Francisco is just a complete cluster F. I was just there, 2 or 3 weeks ago. And Lauren felt so unsafe. She's like, let's go to Palo Alto. So we ended up going to Palo Alto and staying in a hotel there right next to Stanford, which was really nice. But But boy, the amount of vacancy that you have in San Francisco, some gorgeous streets in San Francisco, it's like there are more properties vacant than they're actually occupied. It's terrible what's happening to San Francisco. In addition to that, now you have to start considering how the commercial office space sector nationwide is going to affect the market. You're talking about a multi-trillion dollar segment of loans coming due within the next 3 years here, somewhere around $500 million per year. So call it about $1.5 trillion of loans due 2023, 2024, 2025. Those are going to be up for refinancing. If now all of a sudden rents are lower, valuations are lower, you're going to have some real pain in that multifamily commercial space. When or if that ends up trickling over to single family will remain to be seen, but I think some prudence and patience is going to be very, very important. I do think that'll create some incredible opportunities for house hack, which I know people regularly ask for updates on house hack. We should have our documents into the SEC this week. It was scheduled for June 15th to get it in. It might end up being June 16th, if that's Thursday or Friday. Obviously, on the 16th, that's a coupon expiration day as well. We're adding even more AI lectures. We're adding even more new lectures to all of the courses: stocks and psychology of money, real estate investing, zero to millionaire, and then, of course, the income group, which is the how to make more money and get SH90 done faster, or the sales course. Check those out, all linked down below at meetkevin.com. Or just click the link down below. So anyway, that's going to be fascinating to watch what ends up happening in real estate. So let's pay attention to that. In the meantime, let's see. There's a comment here about Westfield San Fran just handed back the keys to the bank. Yeah, in some part though, you have to also be careful that understanding how this functionally works. When some of the commercial lenders say they're handing the keys back to the bank, it's kind of BS. It's really just a negotiating strategy, and publicity is part of the negotiating strategy, because what they do is they use that to say, hey, look, see, we're telling the world, we're doing a press release that we're giving it back to the bank. But the reality is what they're doing is they're just saying, hey, we need to negotiate our loan terms. And stopping payments, in other words, defaulting, is one of the things that you generally have to do for them to even start talking to you. So until it used to be back in 2011, the only way they would talk to you, and that was really considered short sale year. The only way they would really talk to you, the banks, for a short sale, is if you've already missed a payment. And I always found that very interesting, because it was like, wait, people would be like, "But I'm current. Like, I don't want to miss a payment, because I just want to try to do the right thing. Like, I'm upside down or whatever, and I'm going to miss my payment soon, and I'm calling you to give you a heads up or whatever." Was the argument, and the bank's like, "Yeah, no, we're too busy. We have too many people actually missing payments. So as long as you're willing to make payments, we don't want to talk to you." And I thought I mean, to some extent, it makes sense, but it was also somewhat incredible, because it really somewhat frustrated folks. But anyway, that was back then. So now let's get into a CPI preview mode, and yeah, you've got China, by the way, is expected to come out with stimulus. So stay tuned for some stimulus from China. They're already somewhat reducing rates. But anyway, we have CPI coming out very shortly here. We've got, let's see here, we're about 5.5 minutes away from the CPI data release. And I'd like to just review expectations. There are a lot of expectations that this is going to be a soft report. Unfortunately, that makes me a little nervous that it's going to be a hot report. My base case scenario is that we end up getting a month-over-month core of 0.034. That's 2 digits. I know it's a little confusing, but the Bloomberg Nowcast, as well as the Wall Street consensus, is that we're going to get a 0.4. So I'm a little lower than that. You have Bloomberg economist experts. Their individual groups actually thinks we're going to end up getting a 0.3. That's a little soft. JP Morgan's looking for 0.43. Those are all the core inflation numbers. And that core inflation number will be pretty critically important specifically because it's one of the remaining bear arguments. It is one of the most powerful remaining bear arguments that core inflation is what's really painful. So we'll be paying attention to that core number. By the way, I've been working on improving the color and the lighting of the camera. I am streaming at 720p. That's a limitation of the internet right now. But I think this camera, again, I just want to shout it out. I have an affiliate with it. It's a beautiful camera. It's the best webcam that I've found, and I've been searching for one, so I'm so excited to share it. Just go to metkevin.com/webcam, and you could see this camera. This is probably the best and most form-fitting, flexible camera I've ever seen for a webcam, so pretty excited about it. Okay, so that's core CPI. Next, we're going to be looking at a month-over-month headline CPI. Bloomberg economists are thinking that's going to be 0. I think it's going to be 0, but the Wall Street consensus is actually 0.1 read. So we'll read into the numbers. Obviously, we'll go through the actual BLS report. And as we go through the BLS report, we'll evaluate how the details are actually building up. So we'll pull those up. I have the website ready, and we'll see how that goes. But yeah, right now we're sitting at the last CPI report showing us that CPI headline increase of all goods and services at 0.4. Now we're expecting 0.1. Core is expected to be 0.4, just like last time at 0.4, but we are expecting those year-over-year numbers to come down. So write those down if you haven't yet. We're looking for 4.1 year-over-year instead of 4.9, and we're looking for 5.2 core year-over-year instead of the 5.5 we had last time. Now, I'd like to say something incredible regarding what very, very few. This morning, there was maybe one article I saw that was starting to talk about it. I talked about this yesterday in a video, and it's pretty important, but I want to share it with you. One second here. Got to get that coffee flowing. Excuse me. Okay, so what was important, I wrote this down. So if inflation remains flat between now and next month, which we don't expect that it actually will remain flat because core will probably go up a little bit. But if it did remain flat, we would likely see headline inflation drop to 2.9% year over year next month. So in the next CPI report, which that's a pretty incredibly low number, because psychologically then people would start realizing, oh my gosh, the inflation numbers are actually coming in close to the Fed's target. Maybe they can actually pull this off. And that report comes out on July 12th. Remember, today we're getting CPI on the 13th here. Tomorrow we'll be getting PPI. Tomorrow we'll have the Federal Reserve Open Market Committee meeting. I'll be covering both of those live. And then the next day, we'll have retail sales on Thursday. And then the day after that, we'll have coupon expiration. And then I'll finish my vacation on the weekend. And we'll have some awesome new lectures coming out very soon. So that'll be great. So make sure you get into those courses before the price goes up again. But remember, 2.9% year over year, psychologically, that is really going to be useful for inflation expectations. So that'll be really good. And then next month, if we're flat again, will be 4.6% year over year for core. Also pretty good, both of them coming down. So I'm very excited about this. Okay, folks, somebody's asking, would this be a buy the rumor, sell the news type thing? No, this is CPI data releases are generally buy or sell whatever the hell happens, which is very difficult if you're trading options because, the options market doesn't open for another hour after the data comes out. Well, I have to say I'm getting those butterflies in my stomach, so it must mean we are getting ready. We are getting close. The numbers are coming. Yeah, all right. Well, this is exciting. The numbers will be out within about the next 30 seconds. This is a big deal. This sort of excitement I'm getting reminds me about my paid promotion to recommend life insurance. You can get in as little as 5 minutes by going to metkevin.com/life. Stream like I do by going to metkevin.com/StreamYard. Or, of course, check out those programs on building your wealth. Link down below with a big expiration coming this Friday. Here we go for CPI. CPI is standing by, waiting for that data to cross the wire. It's not out yet. Again, we're waiting for point match, low, slight high. Okay, so 0.1 on the month over month, 0.4 on the core month over month. CPI year over year 4%. Core year over year slight tick up 5.3. That could just be an average measure there. That's pretty good though. We're basically at expectations. There were definitely some expectations that that core number would come in a little lower. We didn't get it a little lower. We did get a match a little low on that year over year, and a tenth of a percentage point high on that year over year number. Real average weekly earnings year over year, negative 0.7%, and the real average hourly earnings year over year, 0.2%. Now, what we're going to do is we're going to get into the actual report as soon as it's available. We're also going to be looking for revisions. So what does this mean, what we have so far? Well, what we have is that year over year, I'm not so worried about that we have a match. I'd like to get into the actual math, and we'll get into that, of seeing what kind of increase we had here. Here we go, though. CPI increases 0.1% seasonally adjusted and rose 4% year over year over the last 12 months. Both of those, well, the first number matches, the second number somewhat soft. Then what you have is, again, that year over year coming in at a tiny miss on the headline number year over year, and then the core number on a 0.1% beat. So let's get into the actual report and see what details we can glean from the Bureau of Labor Statistics. Again, also waiting to see if we have any revisions that'll cross the wire, so we'll cover those, and then we'll see what we've got in terms of hourly earnings. I have the document here. Shelter was the largest contributor once again. We're going to share this screen here, and let's get into it. Okay, here we go. Let's see what we have. So consumer price index rose 0.1%. We already know that. Shelter was the largest contributor of all items, followed by an increase in used cars and trucks. Once again, food increased 0.2% in May after being unchanged for the prior 2 months. Energy index down 3.6% for energy. Good. This is despite the OPEC cuts. We're still seeing oil falling, which is great. The index for household furnishings and operations and the index for airline fares were among those that decreased. Airline fares finally decreasing here. But those increases, unfortunately, they're still in shelter, used cars, trucks, motor vehicle insurance, apparel, and personal care. That is a little broad-based. It's not so great. All items. Okay, let's keep going here. 38-page report. So let's look at the let's see if we can actually get straight to the chart here. Sampling error, that's fine, that's fine, that's fine. Okay, here we go. Let's go to the back of the report first, because this is where we're going to get our services, and we're going to see what Wall Street is saying as well, which will be pretty important. Okay, so here we go. These are going to be our services, and we're looking at that far right number. Tax return and prep, 0.7%. Financial services up 0.5%. Those darn financial advisors. Miscellaneous personal services, 0.7%. Some of those numbers are a little bit on the hot side. Telephone services, look at this. This is nice. Telephone services down about 0.5%. That's good. You've got education down 0.2%. Admissions to sporting events down 0.7%. That's good. You have pet services down 0.6%. That one actually rose substantially last month. So I'm glad to see some disinflation occurring here. That's actually straight up deflation on the month over month. Recreational services, basically here at 0.1%, video, audio, 0.1, that's fine. Negative here on one of them, recreation was negative. Airfare was down negative 3%, just like that negative 2.6% we had previously. Public transportation was up 0.9%. That's a little high there. You've got transportation services coming in at 0.8%. Not so great. Hospital services also 0.8, not great. Medical care services 0.1 to the downside. You've got, here's the rent. Look at, and then I want to see what Wall Street is saying in just a moment. Rent of shelter staying stable at that 0.5% level. And you actually have shelter itself rising to 0.6 instead of 0.4. That's not great. We really want to see shelter roll over, because as we were talking about just a little bit ago, we were talking about rents starting to fall and on a year-over-year measure in 48 out of 100 of the largest U.S. cities. But we're still not really seeing that rental disinflation show up in this CPI survey, which is unfortunate. So then we have other goods at 0.6%. That's too strong here. 0.6 is definitely too strong. Alcoholic beverages, 0.4%. Still a little up there. I'm going to actually mark those as green since those are greens. 0.5% on alcohol, smartphones up 0.7%. That's interesting. Could be good for Qualcomm, big manufacturer of smartphone related chips. Education, we saw that decline. Photography supplies up 0.3%. Newspapers, reading materials, and otherwise up 1.4%. Those numbers are a little on the hotter side. Let's use pink there. Apparel, what was apparel saw a rise in 0.3%. Footwear coming in at flat. Used cars and trucks were negative 0.1%. Oh, okay, that's good. Wait, hold on a sec. No, sorry. New cars and trucks, 0.4 and zero point 0.1. However, used cars at 4.4, pretty hot, just like last time. So another somewhat mixed bag of a report here. I do think it reiterates a pause, but I don't think this is good enough to say that the July hike is out. Okay, let's look at this. So 2-year yields are down 6 basis points. Stock futures seeing some modest gains. Dollar at a session low. The QQQ is a little volatile, but sitting at up about 58 basis points. You've got Shelter, of course, being the largest increase. I call personally my initial expectation here is it's headed in the right direction, but you definitely still have some numbers here that are somewhat sticky, which isn't fantastic because in order to really get that pause in July, we need to see these numbers come down a little bit more. No revisions just yet across the wire, but again, that CPI year-over-year core number coming in at 1/10 hot. Even though it's 1/10 hot, it is still down from last year. Remember where we were, or sorry, last month. Last month, remember, we were at 5.5. We're down to 5.3 now. We were at a year-over-year of 4.9 for headline. We're down to 4% now. That month-over-month number, let me see if I can get an exact read on the number here. Let's see the actual release. No, it's not going to show me here the exact detail. We'll figure out the exact detail. Oh, here it is. I actually have it now. And so if I go to the prior release, let's see here. So this is the core number actually came in at 307.824. And if I divide that by 306,489, I know this is a lot of numbers. Oh my gosh, JP Morgan was right. It came in at 4.35, or I should say that correctly with a decimal point. So my expectation was 0.34. Bloomberg Economist was 0.30. Wall Street Consensus was 0.40. JP Morgan was 0.43, and it came in at 0.435. So JP Morgan was the closest to being right there. So credit to JP Morgan. Very good, JP Morgan. I would call this mostly an at expectations report, but leaning a little warmer than cooler. I wouldn't call it compatible with definitely saying we're in for a pause. We're definitely going to be looking at that July 12th CPI report. That's the next one. So mark your calendar for the next catalyst, and we're going to keep going through some of this report. Mark your calendar for the next catalyst. Next catalyst tomorrow, producer price inflation, 5:30 a.m. California time. I'll be covering it live. 11 a.m. the Federal Reserve statement on a pause, followed by 11:30 Jerome Powell's press conference. I'll be covering both of those live. I hope you'll be here with me. Then we'll have retail sales the next day at 5:30 in the morning, and then we'll have a coupon expiration. We'll be raising the price again on the programs, and that's again because we're consistently raising the prices because we're consistently adding value. A lot of the folks who are joining are leaving wonderful comments in our course member live streams, thanking us for the fundamental analysis we bring every single day and the ideas that we bring to the programs of building wealth. So we hope to see you there. So let's keep going a little bit here with what Wall Street is saying, and I want to get through the report a little bit more as well. But it looks like the 2-year Treasury yields initially flipped higher and then sank a little bit following the data. We're getting some mixed messages and some confusion on the CPI. What this means, it's unlikely to mean there's any kind of change for the Fed in terms of not pausing. I think there's a lot of this market that was concerned that this report would potentially lead to the Fed not to pause, and that was a risk, right? The Federal Reserve there was a real risk here that the Federal Reserve would get a nasty CPI report today. And as a result of a nasty CPI report, that the Federal Reserve would ultimately end up saying, okay, sorry, we thought we were going to pause. Now we're sending Nick T a message and we're telling Nick T, hey, you know what, we have to hike again. That is good, in my opinion, not likely. It is not likely that the Federal Reserve is not going to pause after this report. So to be very clear about that, it is likely tomorrow we will be getting a pause from the Federal Reserve, and markets should cheer that. It's just going to come down to what kind of pause are we going to get? Is it a hawkish pause? Is it, a dovish pause? What are they going to tell us about the importance of wages? We'll look at all of that. But for now, let's take another look over here at some of these charts. So here's the headline, a chart of the headline changes in inflation. Obviously, this is fantastic that we're sitting at 0.1. This is great. This is really in line with disinflation. However, that core number, still a little strong. Still strong on core. These are just some more of the summarized headlines here. Oh, what is this here? This is the unadjusted 12-month figure here. And then here, this is your seasonally adjusted number. So you can see shelter here really rising quite a bit here, which is not great because we started seeing this disinflation trend here. Look at that, from 0.8 to 0.6 to 0.4, and it's popped back up. So I don't like to see that. Overall, it's not the cleanest report, right? Look at this transportation pop back up as well, back to 0.8% here. Not great. You had somewhat of a disinflation trend, at least for a month, although as we know, 1 month does not make a trend. For apparel, we were at 0.3, 0.3, 0.3. That's pretty stable here. For used cars, it was still a little rich over here. Also not great. It'd be nice to see these come down. You are seeing that disinflation over here in new cars. Commodities, also a little bit rich over here at 0.6%. And then, of course, we've got our energy disinflation, which is great. We actually do have some food disinflation. I mean, food barely moving here, which is great because food has been such a contributor to inflation, which isn't great. Let's see if there's any particular details here as we await a little bit more data from the Wall Street folks. Consumer Price Index. Okay, here we go. CPI-U 3.6%. We've got CPI-U, CPI-W 3.6% over the last 12. CPI-U 4.3%. You have brief explanation of CPI. This is fine. Calculating sample changes, and then we get right into the charts, which we've gone through as well. So the banner, thank you for suggesting the banner has a typo. So I don't know why, but I thought it was a brilliant idea to go with MetKevin as some of these links. Both of them actually work. So you can use metkevin.com/join or meetkevin.com/join. Both of them work just fine. But I bought the domain MetKevin because I thought, back in the day, everybody wanted short URLs. That didn't last very long. But anyway, yes, thank you for pointing that out, but it still does work. Okay, so let's go ahead and see what we have here. What is this? Breakdown of core inflation sitting at 0.44%, driven by increased contributions of transportation and shelter. Again, the report is unlikely to change the Fed's mind about a pause in this cycle. However, this could potentially iterate a call for a hike in July, although I would probably still put it at a coin toss, and it's going to be dependent on that next month's CPI report, which is kind of like, okay, great. So today's CPI report reiterates the pause, but we're kind of like moved on for that hike already. Like, we want to know for the hike, like, are we going to get the hike again in July? The good news is next month's CPI, and I want you to take this away, very important. Next month's CPI is so important as well because it's actually going to be your year-over-year comparison to the peak of inflation, June to June. And from a psychological point of view, hello camera there. Sorry, that's the metkevin.com/webcam getting a little excited there. Zooming in a little bit. Everything's getting a little large over here. Maybe it's got pricing power. Good old PP. But anyway, the beautiful thing about next month is really going to be this year-over-year comparison of the peak, and that should be very good. All right, so let's look at super core on a chart. So I'm going to pull up the chart of super core inflation, and it'll just take me a moment to share that. but Supercore is declining, which is very good. So to those who are arguing that Supercore is sticky, there really isn't an argument for that. It is not plummeting. I think there is an argument for that. There's absolutely an argument to be made that it's not plummeting. And that's actually not even an argument, it's just correct. But take a look at what we have when we look at supercore inflation here. And supercore inflation, it's very clearly easing. And this is fantastic. What we don't want is this to remain sticky. So if we draw an arrow, for example, first of all, what I want you to remember is that our peak of inflation's peak was roughly here. Interestingly, Supercore did not actually peak until about here, so about 3 months later. However, we already see Supercore on this beautiful trend down, which is very, very good. I mean, this is a rapid decline here in your Supercore inflation, and you want to see this. This is the leftover bear argument that core inflation is really going to um, uh, stay sticky. There's just no evidence of that. And it's very, very good, very important. Okay, yeah, it's been 15 minutes since the report came out, so we should be able to look at the 5-year break even now. That's actually a very good ask. Thank you for asking that here in the comments. Appreciate you. Let's go see what we can find. So let's see here. So just take a moment. Oh, if it's even possible. Oopsies. That might be a moment here. Okay. Okay, I might have to go to a different strategy. Stand by for a 5-year break even. It might take a moment. In the meantime, it does look like markets are slightly trending up on the news, which is good. The Nike swoosh seems to be continuing. It appears I have created some kind of issue, but that's okay. I have a backup strategy. Always have a backup strategy, because if you do not have a backup strategy, you plan for failure. After all, failing to plan is planning to fail. I don't know why I turned like Irish. Never been to Ireland. All right, let's get this open and let's see what we have. Let's go ahead and close that. Of course, not responding. Now, if I had Adele. All right. Oh, beautiful. 5-year break even down to at 2.11. That is our second low. We are generally at 2.1, and 2.11 does mark our second low for the 5-year break even. That's very good. I would expect that to continue to fall, especially with our next month report where we get our year-over-year plummet. Really, really exciting. So very, very exciting. Yeah, as far as my personal exposure to stocks, I'm pretty much all in. So obviously I have some sort of bullish bias, but I really do try my best to just look and go like, hey, where am I going to get screwed? Because I don't want to be blindly bullish, because if I end up missing something, then I'm the dummy. But look at this, folks. Open Door. We pitched this in the course member live stream when it was $1.30, $1.40, $1.50. We did a really big deep dive analysis on Open Door when it was, again, $1.30, $1.40, $1.50. It's more than double that now in just the last month-ish, maybe 5-6 weeks. It's up 6% here in the pre-market, but almost $2.80. Really phenomenal fundamental analysis payoff on that one. That one really paid off quite well. We enjoy doing that fundamental analysis every day. We've got some good stocks that we're looking at that are very similar, in my opinion, and should have hopefully have some similar upside. So we'll see what happens. GameStop's actually up about 6% right now as well. Looks like the S&P 500 is moving to the tune of about 37 basis points, moving up after the CPI report, and Qs are moving up as well after the CPI report. Looked like you had maybe a very brief pause there in the pre-market, as we evaluated some more of that data. Now, there is some more information that I'd like to go through. So let's go ahead and pull up some more information. Let's see what we have here. This will just take a moment to pull up, and then we'll go through what some of the other suits are saying. As far as the this stickiness argument, though, I'm very, very happy to see Supercore plummet the way it is, stripping out some of the more volatile components of inflation. Certainly, oopsies, certainly gets us away from food and energy, but also oopsies. Hold on. It also strips out the used cars and some of the other elements that are so volatile on a month-over-month basis. Okay, let's get this loaded up. Someone here writes, "I'm killing it with Open Door. BTC flat." Unfortunately, you have you do have a downside for crypto, which is just regulatory right now in nature. Otherwise, I'm sure it'd be participating with some of this risk rally that we're seeing. Somebody here writes, "Our portfolios are up almost 100% in 6 months. Was this a Nike swoosh or a V-shaped recovery?" Well, I've always been suggesting that the Nike swoosh should have been a volatile Nike swoosh recovery. But you're right. The beginning part of it has been very, very Larry Kudlow V-shaped. Somebody on Twitter was asking, what other shapes are there other than a V-shaped recovery in the stock market? And there actually are some reasonable differences in shapes. I mean, consider you could have a W-shaped recovery, which is really in the style of a double dip. You could have an L-shaped recovery, which is unfortunately what China is likely running into. An L-shaped recovery is where you just don't recover. You could have a U-shaped recovery, which is kind of what you saw coming out of 2000, like the dot-com era, 2003. Very, very, very slow, right? Not ideal. So those things can happen. Worth noting that egg prices did come down substantially. Also, we had, let's see here. Okay, I know we reviewed that. We already went through. Airline fare, big contributor to the declines, which is good. It's just those darn autos as well as housing contributing, not so great. Let's see what else we have here. Okay. Oh, yeah, here we go. Okay, so another one. I like this one. So we'll move on from CPI here for a moment. So let me write this down. Somebody's asking for the next Fibonacci retracement for Tesla. It's actually 258. 258 is the next fib for Tesla. I do teach the what I believe is very powerful technical analysis in the Stocks and Psychology of Money group. So if you're not part of that yet, check that out. Okay. Okay. Oh, and remember to check that out before the coupon expires on Friday. You'll get the best price guaranteed. And you can email us for bundle coupons, by the way, at staff@meetkevin.com. Staff@meetkevin.com for bundle ups. Okay, let's now get into this one. This is a very interesting piece. So here's a piece by Cameron Cruz. He's probably one of the people I respect the most over at Bloomberg, and he has a really good article. He talks about the S&P 500 being Schrodinger's market, not a bull market. Now, Schrodinger is a reference to the cat being in a box. If a cat is in a box, is the cat alive? Is the cat dead? Or does it take both states? Is it both alive and dead at the same time? Because both optionalities exist. Anyway, so while many people in Wall Street are no strangers to hard work on a more fundamental basis, human beings are basically lazy. This is the whole genesis of the current artificial intelligence investment craze, which anticipates that huge swaths of the world will use AI to perform tasks they cannot be bothered to do themselves. I love this intro, by the way, because one of the things that I teach in my How to Make More Money and Get SH9T Done Faster course is not that AI replaces you. We're not there yet. It's actually how you can wield AI as a tool that makes you substantially smarter and substantially more capable than the people around you who are not using it. I came across a phenomenal statistic, I believe it was in the Financial Times, but I could be wrong about that, where 58% of people I've heard about ChatGPT, but only 10% of people actually use ChatGPT. And if only 10% of people actually use ChatGPT, that means even fewer people use the tools and procedures that we talk about in the productivity course. And it's actually a very affordable course. You should check it out. But anyway, The article goes on, indeed, laziness is arguably one of the bedrocks of human progress, inspiring generation after generation of technological advances designed to make life easier. For some reason, people often use heuristics or rules of thumbs to simplify conclusions about the economy or the market or otherwise. And so now we have to talk about the bull market, or the bull market that potentially is not. And see, this is where he's going. He's suggesting that sure, the S&P 500 is up 20%, but are we really in a bull market? And so Cameron Cruz says he's found himself bemused by the compulsion felt in certain circles to label the equity market as a bull or bear market. Perhaps this urge has its reminiscence, or has its genesis in some older books, like the Reminiscence of a Stock Operator. It's actually a good one. But anyway, so he talks about this idea that are we really in a bull market if we've just gone from hell up 20%? And so he considers some empirical data. The first thing that he likes to argue is he says that it takes more than a 20% rally to actually prove that we are in a bull market. And I actually really enjoyed this chart because he makes it clear that just because you have a 20% rally does not mean the bear market is over. In fact, this same thing has happened before. And history can often rhyme with, well, the future, as we say. And I kind of butcher that quote. But anyway, take a look at this chart right here. So this chart that I'm showing up on screen shows you it takes more than a rally to make a bull. In 2000 to 2002, we ended up featuring 3 S&P 500 20% rallies. Now that should actually be scary because look at that. You ended up having a 20% rally here in early 2001, in late 2001, and again in 2002. This is why I still maintain that I expect we'll have a Nike swoosh style recovery, but I do think there will be reason for some volatility in the future. I don't know what that volatility reason is yet. I have not found it yet. It could be like a black swan. You just don't know what it is yet. But I think Cameron Cruz makes a very good point here that just because you're up 20% does not necessarily mean you're in a bull market. Similarly, there were 2 different rallies of 20% in the second half of just, I hate saying this year. I really hate saying this year. Any bull should hate referencing this year. You ready for this? 2 separate 20% rallies where in 2008. Look at this. They called it false bulls. You had a 20% rally following the approximately October bailout of by Congress. Congress passed a substantial bailout in approximately October. And then you had another bailout or another sort of rally of 20% in approximately December. But it wasn't until the 20% rally over here in 2009 that we actually sustained being bullish. Ooh, that's not so great for a historical perspective. Of course, back then, it seems like there were substantially more fundamentally risky propositions in the market, which maybe we're lacking today. But then again, you've got the commercial property overhang. You've got potentially still somewhat of a banking overhang. Who knows? Then you've got to volatility adjust your markets. And he makes this argument that if you look at natural gas, which provides an extreme example of volatility adjustment, you really have nothing in terms of a rally. Another way to look at it is he looks at 1-year risk-adjusted returns and suggesting the market is not extremely bullish when you look at risk-adjusted returns. And this is a way of saying that, well, sure, all the bulls might be enjoying their party so far in 2023, but what risk did you have to go through to get that? And that's fair. I mean, a lot of the people who are enjoying the rally here in 2023 entered the market in June of 2022. And so you had to ride through some hell going forward. So, risk adjusted, your returns might not be that fantastic. Although year to date, returns certainly look quite juicy. Also, another fair argument. The other thing that he argues is he's looking at, let me skip that one. Oh yeah, here he goes. He goes, not every market is created equally, but of course, you knew that already. It's no real surprise to see US markets have been in a bull market more frequently than those in Europe or Japan, though it's notable that the Russell has enjoyed bull market conditions less frequently than the Nasdaq or the S&P 500. It's also interesting on this definition that each market has been in the intermediate phase of between 15 to 20% of that time, or in the intermediate phase between 15 to 20% of the time. That kind of, okay, that's a little confusing what he's saying there. Basically, getting stuck between the 15 to 20% level, I understand. But ultimately, he argues that, hey, look, while things may seem bullish right now, and maybe there's a lack of substantial negative catalysts, we have seen this before. This movie has played before, so to speak, of the markets suggesting that, oh, we're definitely in a bull run, and then what ends up happening? That 20% gain just ended up leading to some more pain. Of course, it gives you a buffer, right? I mean, if you were in the market and you were able to enjoy the 20% write up, at least you have somewhat of a buffer. And that actually somewhat, in my opinion, reduces your risk going forward. Because think about it, if you've had a 20% rally, you have more of a buffer now than you did before, right? Which is actually a great thing. So let's take a brief look here at the cues. So we are actually riding on top of the Fibonacci level here of 248, which is great. Next stop is actually 373. And guess what? I think we might hit that 373 level after the Fed's pause. So buckle up. But even though Cameron suggests that, hey, maybe it's not a bull market, fine. After we get a Fed pause, I think there's a good chance we could test this 373 number. Now, is there a risk that we might end up rejecting off of that? Absolutely. Especially as we wait tenuously for the July meeting. But for now, this is not bad. So we've got some excitement potentially here. If we look at the S&P 500, next stop is 445. If we look at Tesla, the next step is 258. If you look at SoFi, honestly, very, very good. It's doing very, very well. A massive movement here in personal loans, really leading to a reiteration in earnings for the company. Though there is a question in terms of how long those personal loans will support SoFi. So that'll take some fundamental analysis to evaluate. But a very nice rebound here, although if you look at the week chart, obviously still an opportunity potentially to buy if you were so inclined. It's not for me personally. Carnival Cruise Lines, though, that's another one. We've done quite a bit of fundamental analysis on this one, and it's had a nice rebound here. 12% yesterday, up 3% again in the pre-market today, whereas Apple in the pre-market is actually sitting down about 2.29%. A little bit of softness here. So pay attention to how these stocks move in the morning. It'll be very fun, but I have to say, as far as this report going into the open, it does look like you've got some optimism going into the open, and that might end up holding. Of course, JPOW tomorrow, so there could be some, tempered optimism going into the JPOW meeting. Though I will say broadly, this is so long expectations that it doesn't make sense for the Federal Reserve not to pause tomorrow, because this is really mostly in line with expectations. It's not as great as maybe we had hoped, but we still got some great numbers. Now, Nick T also provides some annualized rates of changes. This is actually an interesting piece. Let's take a look at what Nick T has to say. He's done some math for us, so I'll have to shout out Nick T here for some math. Thanks, Nick T. All right, let's go ahead and share this video screen. Keep in mind, I use StreamYard. It's a paid affiliate here to share these screens when I'm mobile. It's actually pretty nice and convenient to throw up these banners and share screens. Thanks to StreamYard. Go to metkevin.com/StreamYard to support the channel. So what do we have here? We have CPI for May 2023, 3-month annualized of 5%, 6-month annualized of 5.1%, 12-month annualized of 5.3%. So you see this slowing here, which is good. And then you actually see this bizarre hiccup here in the core CPI. 12-month is 6% annualized. 3-month is 5.8%. 6-month is 6.4%. So a little noisy there on the 6-month. But if you actually look broadly at the chart, the trend is very clear. It's hard to call it sticky when it is slipping. Is it plummeting? Absolutely not. But it is a nice a trend down here. So that's very, very good. We like to see that. So we'll continue to evaluate how these moves go throughout the day, obviously. But I would say broadly, this is very positive. Now what we're going to do is I'm going to move a boat, and then I'm going to go over to the course member live stream and pour myself another cup of coffee. So wish me luck while I move this boat, and then I'll see everyone in the course member live stream in about 20 minutes. In the meantime, thank you so much for being here. I hope to see you tomorrow at 5:30 a.m. for PPI. I'll probably start streaming at about 4:20. That's California time. It's about 7:20 Eastern. My goal is to go live every day at 4:20 a.m. California time. That is my goal, and I hope to see you there. So anyway, thank you so much for being here. We'll see you in the next one. Goodbye.